Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, November the 3rd, and wanted to take just a brief moment to discuss what markets did last week as we are coming off the best month in the Dow Jones Industrial since 1976. So a great recovery month for equity markets, and the S&P 500 finished the week up last week 3.95%. The mid-cap index finished up much higher at 5.31%, and the small caps higher than the large caps as well at 5% up for the week. Now, all eyes this week as we were heading into it were what was the commentary going to be from Chairman Jay Powell after their meeting on November the 1st and November the 2nd, and what trajectory of rate hikes would look like in the future, and if they were signaling a time that the market would pause. So we got in and we got the statement yesterday that came out after the meeting at 2 o'clock on Wednesday that said that we were raising rates by 75 basis points. However, there is a potential for rate slowdown in the future, rate hike slowdown in the future to absorb the monetary policy that's already been enacted so far. And you saw the stock market and the equity market turn very positive after the initial release of that statement came out. And then 30 minutes later at 2:30, Chairman Jay Powell stood up and gave his Q&A press conference. And that's where he kind of walked that back a little bit, almost speaking out of both sides of his mouth, saying that they're seeing economic slowdown, especially in housing, which comprises 40% of the CPI index. So they're already seeing significant slowdown there, but also saying that they believe that they were going to have to go further than they initially thought back in September on where the federal funds rate lands. So economists and the expectations going into this meeting were that the Fed funds rate would land somewhere between 4 and 4.5 on the short term, and that would be where rates would end. However, after the press conference yesterday, you really saw short-term interest rates take off to the upside. You saw a lot of selling in treasuries and yields increasing after those comments where Chairman Powell basically said we are going to have to raise higher than we initially thought. So now we're thinking 4.5 to 5% may be where we end up. But understand that the Chairman Jay Powell is going to sound more hawkish than what he may in fact actually do. It is our anticipation at River Place that they're going to raise rates in December, not by 75 basis points, but by 50. And that there will be maybe after the February meeting, maybe a chance to let the market digest what has happened. There's also a lot of time to get more recent data between now and their next two meetings in December and then February to come. So the market digested all of that, and then you saw a lot of selling pressure into the equity markets yesterday. As yields increased, the equity market went down, and that's kind of the bifurcation that we're in right now. If you see yields rise, you see stocks fall. You see yields fall, stocks rise. And then if you report good corporate earnings, your stock goes up. And that's the market that we're in right now. And the value sector continues to be the winning sector here in these equity markets that we're seeing. Because they have pricing power, they don't have high cost of capital, and they're more mature businesses that have fortress balance sheets and return capital, whether in share buybacks or dividends to shareholders. And those are what's winning in the equity markets right now. The other thing to point out, and this is a big point to make to understand moving forward and as we navigate through this, is that the stock market and the economy are not always moving hand in hand in sync together. The equity market is pricing in a recession for 23. That's what we've been doing all year long, is pricing in an economic slowdown for the United States. Well, we had an inventory correction, an inventory recession the second and third quarter of this year, and we expect there to be some recessionary environment's potential as it rolls through the service sector, which makes up 70% of the economy, and that is when you're going to really start to feel more of the effects of any type of recessionary activity. And what you may see is that you'll see the equity markets, once we get to that point, actually start pricing in the recovery while the economy is still feeling the pain. So right now the economy is still strong. Unemployment is incredibly low. It's at 50-year lows. Wages are increasing, and the consumer is still strong. So the equity market's pricing in the future of the slowdown. And when the slowdown comes, the equity market's going to price in the recovery before the recovery actually happens. So understanding that is essential in how to navigate through this market. So just stay steady as we navigate through this, and call us with any questions you may have, or if we can help you navigate through that, we're happy to do it. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everybody has a wonderful rest of your week. Thanks so much.